Welcome to the second episode of Mastering the Basic RSI. In the previous video, we introduced the RSI indicator and discussed why it's so popular among traders. If you haven't seen it yet, make sure to check it out through the link above. In this video, we're going to learn how to calculate the RSI step by step with an example. Understanding the formula behind each indicator helps us use it more effectively and with greater confidence. So, let's dive in. Steps to calculate RSI. Step 1. Calculate the daily price changes. First, you need to look at the daily price changes of the asset. For each day, subtract the previous day's closing price from the current day's closing price. This gives you the price change. If the closing price today falls below yesterday's, the price change will be negative. On the other hand, if today's closing price exceeds yesterday's, the change will be positive. Step 2. Separate the gains and losses. Now, separate the gains and the losses. For example, if today's price change is negative, count it as a loss. And if today's price change is positive, count it as a gain. Step 3. Calculate the average gain and average loss. To calculate the average gain and average loss, the most common period used is 14 days. This involves calculating the price change for each day over the past 14 days. To do this, follow this process. Determine daily price changes. Calculate the difference between the close price of the current day and the close price of the previous day. This gives you the price change for the current day. Classify as gains or losses. If the daily price change is positive, record it as a gain in the gains column. If the daily price change is negative, record it as a loss in the losses column, using its absolute value. Compute averages. Add up all the values in the gains column over the last 14 days, and divide the total by 14 to find the average gain. Similarly, add up the values in the losses column over the same period and divide the total by 14 to find the average loss. This process allows you to measure the average price movement in both upward and downward directions over a set period. Calculate the relative strength, RS. Once you have calculated the average gain and average loss, divide the average gain by the average loss to obtain the RS ratio. This division directly gives the RS value. If the average gain is greater than the average loss, the RS will be greater than 1, which suggests an upward trend. Gains are dominant. If the average loss is greater than the average gain, the RS will be less than 1, which indicates a downward trend. Losses are dominant. Calculate the RSI. The Relative Strength Index, RSI, is derived from the relative strength, RS, and serves as a momentum indicator, scaled between 0 and 100, making it easier to interpret. It does this by adding 1 to the RS, dividing 100 by 1 plus RS, and then subtracting the result from 100. The formula converts the RS value into a percentage that lies between 0 and 100. This 0-100 scale makes it easier to understand and compare across different assets or time periods. Thresholds: 70 or above. The asset is considered overbought, potentially overvalued, may face a reversal or correction. 30 or below. The asset is considered oversold, potentially undervalued, may rebound. 50 represents a neutral point, showing no strong trend either way. This standardization helps traders make quicker, more informed decisions based on these thresholds. And that's how you calculate the RSI. It's a powerful tool for understanding market momentum and identifying potential trend reversals. In the next episode, we'll dive into overbought and oversold zones and how to use them for generating signals. Thank you for watching. Don't forget to like and subscribe for more technical analysis tips.